Well, hello everyone. It's Ken Winans and Stephanie Larson, and as we told you folks last time, we were going to give you an update as we were going through earnings season on what we were seeing in the markets and all that. And I think it's safe to say that certainly the first quarter of this year has been interesting at best. I know for those who have read my Forbes articles, we are doing a very strange redo of the 1970s all over again. I've been talking about for over a year about the inflation pressures. And unfortunately, folks, it's not going to subside anytime soon. Rates are going to start going up at, I think, a faster rate.
Yeah. The Fed is hinting that they're going to do a 50 basis point, if not more, in May. So that's the expectation. At the minimum, it's going to be 50 basis points.
And we're also even we haven't really started talking about it yet, but we are in a midterm election cycle. There's going to be a lot of talk coming out of Washington. I think there's going to be a lot of people trying to point fingers at who's responsible for what through all this. And anyway, 2022 is not going to go down as a year that most of us are going to want to remember. But let's talk about how you handle this. So, as you know, as you can see from the gray in my beard, I've been in this game a long time. I've been through many market cycles, and many of them with you, our clients. Yeah.
So you're saying you're old?
Yeah. Well, I'm seasoned. Let's put it. I'm very seasoned. But anyway, what typically happens in bear markets? Okay, and we are in a bear market. And by the way, I think it's not just in stocks. Housing's beginning to soften. Bonds, everything except commodities. As you know, you all see some sizable positions in commodities, and in fact, we did recently just add soybeans to the portfolios.
We're doing that on Monday.
On Monday, okay.
Monday.
Sorry, but
we were unloading today.
Yeah. So
you'll notice a lot of trades have gone through your portfolio today. I'll let Ken talk about it, but we were aggressively redistributing some of the positions, and we're going to do a leadership change in the portfolios.
What's working right now are commodity-based companies. Mm-hmm. So a good case in point, we have oil and gas stocks that are being added to the portfolio at opportunities. There's other type of companies that, again, not necessarily in mining, but they're companies that do benefit from commodity moves. We will see those in the portfolio. You're going to notice that we've trimmed back or have eliminated some stocks that many people might see as very popular companies, but do keep in mind, I don't care about a company's popularity. I care about how its stock performs. And when I see what's happened to, especially a lot of the stocks we used to call the FANG stocks, which are those very popular tech stocks, and they've all gotten very badly mauled, excuse the pun, in a bear market.
Yeah. I mean, look at Netflix this week. I mean, it's just getting slaughtered. Amazon's having a really hard time. Google is having a really hard time. I think Apple is the shiny star right now, and
Microsoft's holding up pretty well.
Yeah, Microsoft not technically a FANG, but yes, it's definitely one of the bunch for sure. But Apple and Microsoft are the only two you can sort of hang your hat on. One of the things that I've noticed, and I was talking to Ken about this morning, was that some of the broad market ETFs, if you want to look at what they're doing, especially the small cap and SPY, the DDM, which is the Dow ETF. They've done what's called a death cross in the last couple weeks. It's a technical term, which just means that the 50-day moving average is crossed below the 200-day moving average, which is a very bearish signal. So what the market's just telling you is that this is not over. The discussion Ken and I were having today in our investment meeting was, is this the start of the second leg or not in a bear turn?
Mm-hmm. And just keep in mind, so bear markets, they do have these cycles. And the ones that I think are more pertinent to what we're dealing with right now would be something that we saw in the late 70s, which was years of things vacillating back and forth. Mm-hmm. But in more recent times, it would have been 2000 to 2002, mm-hmm. where were several years of there was just no upward moving momentum. Things were pulling back. But in those times, you do get buying opportunities. And so when people say, Ken, you guys are sitting on a lot of cash right now, or you're hedged, there will be those times where we will commit that cash, whether it's a general rotation in some of the names that I mentioned earlier, into companies that will do well in this environment, or there's enough of a flushing out of the excess valuation that a lot of the names that we're selling now, we can buy back at lower prices. Just because we're selling them doesn't mean we're no longer tracking them. We continue to track all the names that we just talked about. I will continue to track them. But right now, I think there's more downside risk than upside potential with the names that we're getting rid of. So you're just going to have to let us, we know how to handle these kind of markets, folks. You know that, we know it, and it's not one of those kind of things you want to turn your back on it. Let me just also say very quickly, I've been asked by a lot of you about the commodity play. The commodity play is going to run for several years. This is not a quick pop, hurry up and get rich scheme. This is going to go on for a while. We need to be prepared for that. And then in the case of the bonds, we're going to talk about that in a moment. There are going to be opportunities in all areas where you can step in and buy. But again, you have to be patient, wait for your opportunities, and then just don't let things that are not acting well turn into nightmares. And that's unfortunately a lot of people who have just wedded themselves to the belief of buy and hold, that it always bounces back. Again, remember how long it took a lot of people to get their money back after the dot-com bubble, or certainly after 2008. There are times to be defensive, and this is certainly one of them.
Well, and one of the things that part of our evaluation today on the stocks that we sold was if it's below the low of January for that company, we wanted out. And so that's one of the things. If this really is a second leg and it's already testing the low from January, then that's a really bad sign. So we didn't want to hold on to what we call problem children. So we got rid of the problem children today. But a good also example and something to really consider and to think about. Sometimes when a stock gets beat up really badly, Netflix is actually the perfect example of this. In the summertime, it went from the high 700, I think, down to the 455 range price-wise. And people were like, oh, look how cheap it is. Let's buy some, Well, you have to be careful, because where is it now? It's bumping around the $200 range. And the reason is so those bear traps of you thinking, oh, is this a dead cat bounce? Is it going to keep going down? Or was that over-aggressive selling by some ambitious traders, and that's an interim low, and let's buy it on the pickup because now it looks cheap? Making those kind of decisions aren't really investing decisions. Those are gambling decisions. And so we're trying to avoid that. And I have had a few people ask, like, well, stocks looks pretty cheap right now. Not necessarily, and it can easily get you stuck into something that's only midway down. So that's something that we're considering as we're evaluating the choices that we make. You'll see that the hedge is still there. If your hedge was light, it got increased today. We actually debated increasing it even more. We got rid of the problem children. We're sitting in some cash. We do have some names we like. There are a few that we've been evaluating, oil and gas plays, and a few others that we're going to probably move into, including soybeans. That's set for Monday.
And utilities. We're seeing a lot of plays in utilities.
Yeah, and so there will be a few things that we buy. So don't look at us kind of like, well, you're saying everything's bearish and scary. Why are you buying me something? We're only going to buy something if we really have conviction in it, and it showed that it's actually weathered this year well. If it hasn't, then obviously we don't want anything to do with it.
Yeah. Let's talk a bit about bonds. A lot of you have been calling here, expressing concerns about bond volatility. Let me start out by saying, not to shamelessly self-promote my books, but I know you all have a copy of my 2 income books, and I'm going to be just telling you to go and at least read chapter 1. Okay, so what do I mean by that? The difference between a bond and a stock is it's still the same thing it's always been. There is a certainty that a bond has a price in which it comes due at, that the company has to pay you, not the market, but the company has to return your principal, and it has to pay you interest 2 times a year. What you're looking at on your daily stuff, and I know, even though I'll tell you guys not to do it, you all do, you'll stare at your phone and look at what your bonds are priced at on a given day. I see that exercise very similar to somebody staring at Zillow about their home value every day. It is an estimate, at best an estimate, that if you were to sell the bonds that day, that's what you would get for them. And it does not take into account all the income you're going to get on that bond throughout the year. So folks, again, repeat what I just said. When we build a bond portfolio, we do not plan to sell the bonds. We plan to keep them to maturity. Bonds when you have an existing bond, the price of that bond will go down in value as interest rates go up. But once the bond comes due, it has to pay you back at what we call par value. I know it's difficult. None of us like to see things go down, but I would just caution you, don't treat your bonds like your stocks. They're not the same. Be careful on that. And it's better to pull out your reports that we give you and look and see what your estimates are on income for the entire year out of your bond portfolio. But most of you are still looking at yields that are 6 and above and climbing as we're buying new bonds. The yields are actually much higher, and your average maturity is still coming in somewhere between 3 and 4 years. This is a very short-term portfolio, and I just caution you, be careful I'm not telling you not to become concerned, but I'm saying ask the right questions, and to be overly concerned about the value of your bonds, you're needlessly worrying.
Well, the most important thing, if you look at your quarterly statement, is to look at what the market value is, which is the quoted price, and what the value of the face value of the bonds are. So the face value of all the bonds that are going to be due to you could be $1 million, but the market value could be $900,000. It doesn't matter if it's worth $900,000. I'm not going to sell them. So really, it's the fact that it's going to be $1 million. That's the most important part. And then flip towards the end that shows your projected income for the year, and look at that. And that's and look at what's been paid already in the first quarter, which is usually maybe the 1/6-ish amount of your income for the year is usually the first quarter. The heavier quarters tend to be 2 and 4, not exclusively, but tend to be. So that's the most important part. But what is actually interesting is the fact that since the beginning of the year, treasuries, short-term treasuries, so the 2-year treasury has gone up from 0.75 to 2.75. That's a 200 basis point move on short treasuries. The longer treasuries, the 10 years, have moved up a little bit, but not the same. And that's really aggressive. That's a huge move in the bond space. And the thing is that higher yields aren't really there yet. And you know, the Fed is raising rates, but it's raised a quarter basis point. The market's acting like they raised rates 5%. It's not what's happened. Markets tend to bake things in early, which is what the market's doing, unfairly, kind of, because they're trying to get ahead of it. If you look at all of our bonds on our book, and you look between 1 and 3 years on maturity, you haven't seen a lot that have moved. They're all pretty much hanging in the 90s price-wise or higher. You go 4 to 7 years, the bonds are really in the 90s. Anything after 7 years maturities, they're really in the 80s price-wise. They're just getting picked on for being longer maturity. It's not credit risk. It's not any concern of defaults. There's no risk concerned with that. It's getting picked on for when it's due. I'm actually, so one of the things we've done is we've shortened the maturity schedule for everybody. We've also trimmed all of our preferreds. We talked about that in an early video. But one of the things that I'm actually considering that I was going to talk to Ken about in the next investment committee was that, we front-loaded the portfolios. I would say probably 60 to 70% of almost all the portfolios they're going to be due in the next 3 to 4 years, maybe 5 at the most, but not really. If you go to those 7-year bonds now, though, and they're trading in the 80s, that means they're at a 18% discount. So the yield to maturity is actually really high for these bonds. And now I'm kind of considering, well, if the short-term maturity is big enough, you have a chunk of your portfolio there, maybe on a special situation, try to go after a few of the little bit longer ones just because they got so beat up this last month. That's why the prices of the bonds have gone down in the last 6 weeks. Everyone's concerned about the Fed raising rates. And anything over 5 years has just absolutely gone smashed. So it might actually behoove us to lock in some of those, because one of the other truths behind the bond market is that bond prices always go first. They go first to the downside, and they go first to the upside. So what we're seeing is the market rolling. The bond prices have led it for 6 weeks now. And then it will go equities, and then it will go commodities. Commodities are always going to be the last ones to the party. So when commodities turn south, that's when you've really hit a bottom. But bond prices will come back up first, and it might actually be a good idea to take advantage of some of these really cheap bonds. So it's something that we're going to do. It's exactly what we did in March of 2020. That was just a much smaller window that happened in, because it was such a shock crash. This one's longer because it's going to be a bear market, but there are going to be some real buying opportunities out there. And even on the short end, I'm still getting 6% for bonds. It's not like you're having to sacrifice a lot, but maybe on the slightly longer ones, maybe it's more like 8.5. So the bond space is interesting. I know watching the prices deflate a little bit is a little depressing, but just keep an eye on what the maturity value is of your portfolio. And if you need help finding that, just call me and I will point it out for you on your latest report, and we can talk about this specifically. And even then, with all of the price movements of the bonds, there's only one that we're watching on our watch list. So it's not, and that's the only one that is a concern. So the bond space is actually really healthy. The prices are just getting a little inappropriately deflated at the moment, right?
Yeah, and just keep in mind that we all knew that the adjustment from the Goldilocks years we've had for really the last 20 years to a more normal world, which is where you do have inflationary pressures, you do have normal interest rates, you do have this adjustment period is volatile. At some point it will stop. There will be opportunities. We'll be able to make money. I do think that we do have to factor in the possibility of stagflation, which is slower economic growth with rising inflation. Folks, we've seen this before. If for any other reason we do put history in the driver's seat, we look for things that can perform well in there. But my feelings are, as they always are in any kind of market correction, the cash we raise, the direction we pick, it is to put us in a position to be able to go after things at an opportune time. And whatever losses there might be in the temporary phase, we have a history of being able to make those back quickly.
We did it last year.
We did it last year. So my feelings are, you are working with a manager who does have respect for history, knows how to operate in this kind of an environment, and I appreciate you giving us that confidence and trust. We know what we're doing, and so we're here every day. Game on. We know what we have to do, and we just ask that best thing you can do. I mean, just don't look at your phone every day. There's no point to doing it. I recommend quarterly reviews of your portfolio. There's no reason to look at it more than that unless there's a change in your lifestyle. I mean, I think discipline in investing also is in discipline of being a good investor. And it's not to do these knee-jerk calculations on your portfolio because you heard something, either you read it on social media or you saw it on a financial show. It's not the way to do it, folks. And it doesn't help you. It really doesn't. So listen, with everything that's been said here, we're not done with earnings season yet. We'll do another video in a couple of weeks, and I want to
see what comes next.
Yeah, exactly. So yeah, just hang in there, everybody. This too shall pass.
Yeah, it will.
So take care, everyone.
Bye.